Today, we are talking with an investor from New York who has essentially tried it all, right? He was trying to invest in his backyard. He was trying to self-manage, do all the things. And then he finally decided to invest remotely in Jacksonville, Florida. We're going to analyze what he had to learn to get there and the obstacles he had to overcome. Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
And with us today, a local legend in our community. We call him Il Maestro because he shares the name with a world-famous composer, and he allows us to have a good sense of humor. John Williams from Long Island, New York. Welcome to the show, John.
Thank you, Pablo. Thank you, Greg.
Good to have you, man.
So nice to see you, John.
Thank you.
Maestro, people are here to hear your story, my friend. How does that feel?
Okay.
So, John, you were telling us that you initially were interested in real estate in the early 2000s. Is that kind of like when the journey started for you? You were seeing infomercials on the TV. Talk to us about like first kind of like why did you want to get into real estate? Like what was attractive to you about the asset class?
Wealth building, basically building wealth, long-term wealth was what attracted me to real estate. And so I wanted to get but at the time I didn't know because real estate is just a wide area and I wasn't sure where in real estate I wanted to be. So I started to investigate and look into different avenues of real estate. And then eventually I decided that single family homes were going to be the key for me.
Yeah. And so when you were doing that, what were your first kind of like steps into it?
Well, I went online, bought courses, bought books, read, not just getting information basically to see where I wanted to go, and started to try with my feet, but trying to self-manage didn't work because it's a hard work managing your own properties, especially if they're not there. Because the mistake I made was I went way out of town, Harrisburg, Pennsylvania, with some people who were doing it there and thought I could have done it and self-managed, but it didn't work out very well. And then the crash came, and so I had to jump ship.
Yeah. And, I think when you're getting into real estate and you are looking at the books and the tapes and the courses and the friends that you meet, it's very easy to kind of have shiny object syndrome, right? You hear that maybe this was successful over here and maybe Harrisburg, Pennsylvania is where you should be, even though you're living in Long Island, New York. And, I think what a lot of investors lack is a true strategy and a team to support it. Is that some of the things that you learned early on with some of those hard to learn lessons in the beginning?
Yeah. I realized I needed a team, and I didn't have enough knowledge to invest in real estate, which is being a novice. You're going to make a lot of mistakes if you don't have somebody to guide you. And so that was my downfall. I didn't have enough information, and I didn't have a team that was going to work with me to get it done. I was trying to do it all by myself, and then doesn't work.
Yeah, and especially you need a team if you're going to be remote. If you are living in Long Island, New York, and you are investing anywhere in Jacksonville, Harrisburg, wherever, the team is the most important part. It is second to none, because if you're going to win in real estate, you have to be in the game for a long time, right? If you are going to win in rental properties, you need to buy and hold for a full market cycle. And if you don't have a team to support you, there's no way you're going to stay in the game long enough.
And that's one of the things I learned from JWB about the cycle. Because I wasn't looking at it in terms of the market cycle. I was just jumping in, trying to make cash flow. Because in my mind, I'm thinking cash flow is what does it. But then I learned from being on the podcast that there are 5 market profit centers. And when I started to understand the profit center, then it makes sense that it's not just the cash flow, but it's what you do for the cycle with the profit centers. And the podcast was a big help. Greg with the knowledge and the data and the information, probably it hit home. I really started listening to you guys in 2024. And so when I got a little knowledge and I heard and I realized, we had a team in place that I could be successful if I just have trust the right people. And I've heard you said it over and over, Greg, that a lot of times we try to find a property and then find the team. But then if you find the team and then the property, it makes more sense because you have the support system in place that's going to help you to succeed. And that's what I learned from being with the JWB and being in the community, because not only did I hear people who were using the system being successful and accomplishing their objectives and their goals, I realized that I could also be a part of that. And so I tuned into the program week after week, month after month. I was there just listening and learning. They got to the point where I said, let me try. And so December 2024, I bought my first property with JWB. And I said, okay, let me see where it goes from here. And funny enough, 7 months after, I bought 2 more properties.
Yes, you did. John, that's just really incredible. I'm curious, do you remember when you started listening, how many shows do you think you listened to before you built up the courage to take that leap of faith and buy your first property, if you had to guess?
I think I started about March, April, somewhere on there. Because then you had a lot like the chef on the program in BB, and I'm listening to all these people talking and hearing which I've come to know through other sources, talk about how the support that they were getting and the team that was in place, and that helped to build my confidence in JWB. And I'll share with you another story as we go along about what helped to cement my trust in JWB, why I wholeheartedly believe that JWB has my interest at heart and why they're going to help me to accomplish my dream. I'll share it as we go along.
Yeah, go ahead and share it.
Okay. When I bought in July, when I bought the 2 properties, a week after I closed on one of the properties, a tree fell and damaged the roof of the new house that I just bought. Here I know, stuck with the property, just no money. Well, we were basically not collecting any money from it, and the roof was damaged. And I had to fix this roof out of my. Thank God I listened to Greg. Put a little reserve money aside. So when you have it, so I had a little money put aside. But I got in touch with JWB and I said, and I cannot hear it my concern. I just bought the house and the roof is gone. And now I have to find almost $2,000 to repair this roof. And my portfolio manager said to me, let me take this to my manager and then I'll get back to you. And the next, he had went to the meeting, and at the end of the week, coming back, he said, tell you what, out of good faith, we will done half of the repair of the roof for you. I said, what? He said, yeah. I said, man, I've never heard of a company that would have done that. I just got in, and they volunteered to help me fix the roof. And I said, man, this company is solid.
That is wonderful.
Then I brought me around to get my money.
Well, thank you for sharing that. Just like you have this long-term mindset and the full market cycle, that's the way we look at bringing a client on, especially when we get to learn more about their goals. A lot of your goals are big goals. They require you owning 3, 5, 10, 20 properties in order to get there. So when we make decisions like that, it's in the interest of a mutual long-term win. And, the great thing is that my team completely makes those decisions. I didn't even know about that. And that's a beautiful thing, right? It is a team here of 120 plus individuals who are empowered to make really, really good decisions for clients. So thank you for sharing that one.
It's really interesting. I went to dinner last night with Doug Segulio, who was here for Summit also.
Oh yeah.
And he said a very similar thing, right? Like there's a certain level of believing in the operational prowess of JWB, of doing it right. But he also mentioned this idea of like, I also really believe that if there was something that went sideways, they would do the right thing.
Yeah.
And I don't think we've really talked about that a lot. Like, I feel like that's something that Lee, I remember the first time Lee showed up on the show, he cried about it.
Yeah.
Not that Lee doesn't cry out.
Yeah, he cries out.
He's a crier. But this idea of, of doing the right thing is something that you hear scattered around the community and people talk about it. I know that you guys also did it with me as well when I had a particularly difficult turn. Can you talk a little bit about how you guys have, it's easy to think whatever, 4 guys at the top of this thing, they'll just do it. But now that you're at like 125 teammates,
Yeah.
And you're not even finding out about it, right? Like,
Right.
Can you talk a little bit about the structure of how those decisions are made by your team?
Yeah, we empower our team to make really, really good decisions. Thank you. We empower our team to make really, really good decisions. And we train our team. We give them the opportunity to make those decisions. And we get the opportunity when you train your team to be able to make those decisions and you are not the one pulling the strings. Obviously, it's leading to that type of growth, but there's learnings along the way. And what we have really found all along the way is that as we train up our next group of leaders to make some of those more difficult decisions, not only do they make good decisions, they ultimately own their part of the business to a degree that just wouldn't be possible if they weren't those decision makers. And then what we find is that what they create in their little hole of the business is so much better than what it was before, and so much better than I could do or my business partners could do. For those who were at Summit this weekend, you all went out of your way just to talk about the teammates at JWB. I mean, really, I think that was probably the most impactful moment, especially for those who came to their first summit. It was not just getting to meet me and Pablo, it was getting to meet those other, 20 or 30 teammates that were there. Well, those teammates care so much because they have they own the business, right? They make the decisions for John or for you or for other clients. So we certainly build leaders up, and it's been that way for 20 years.
That's pretty awesome. It's pretty awesome. John, you were also talking about, well, I guess your first real estate deal wasn't necessarily the first time that you became an accidental landlord wasn't necessarily on purpose, right? Like you were telling us that first you moved from Jamaica to the United States and you were trying to like manage remotely. Was that, were you trying to hire a property manager over there? Or were you trying to do things over the phone? Did that inform kind of like how you move forward in Harrisburg?
No, in Jamaica, I had my family, my friends, but it didn't work out.
Yeah.
Didn't work out.
Yeah. Try being a remote landlord in the same country, trying to be a remote landlord in a different country. Imagine that would be very, very difficult.
Yeah. So you had that Harrisburg experience. You were driving back and forth from Harrisburg, trying to do everything yourself. The Great Recession happens. You didn't lose faith. You still wanted to stay in real estate. You reinvested in education. Talk us through what it took for, going through the hardship of the Great Recession and having to walk away from a property, but still seeing through it, right? Like these are kind of like the stories where it feels like nobody ever gets it right the first time, myself excluded, thanks to this community. Nobody gets it right the first time, right? Like what kept you, you also mentioned that you were having a job that you were very like highly paid, right? Like what stopped you? What kept you still going after real estate as opposed to other options that you might have had?
Because I realized real estate was the only way to build true lasting wealth that it would pass on to the next generation. It's funny, when I got involved with JWB, I said to my eldest son, your dad has finally made a decision to be a real estate investor. Because I've shared with my family that I want to be a real estate investor. And they've seen me try, but never really made much of it. And then when I found, I'll tell you my age. I'm 64-year-old. Okay. And then I said to him, Bo, but at the time I was 63, I said to him, your dad has finally fulfilled a dream that he has always wanted, to be a real estate investor. And what encouraged me when I heard the other members of the community talk about their journey and their goals and their vision, I said, well, it's not too late. I said to my son, there's a proverb that says, when do you plant a tree? And he said, I don't know, Dad. I said, it is said 20 years ago, you plant a tree. I said, when is the next best time to plant a tree? I said, no, I might not have reaped the benefits of planting a tree 20 years ago, but if I plant a tree today, 5 years, 10 years, I might not reap all the benefits of a tree, but I'll reap some. So what I'm doing, and my family is very dear to my heart. I said, what I'm doing, I might not reap the full benefit of what I'm doing with JWB, but I'm planting the seed so you guys can reap the benefit. I want to leave a legacy for you guys.
Mm-hmm.
So I put the seed in the ground so that 10 years, 15, 20 years from now, when it starts to bear, you can reap some of the benefits that I didn't get. And so I'm doing this really for my kids, my grandkids. That's where and that's what I told one of my goals, to leave a legacy for my family.
How special is that? That is so special, John. Thanks for sharing that. It's really something that our community cares a lot about. It instantly brings me to Lee talking about why he's investing MVP. It's to make his wife proud, right? To be able to not just make the money that we can make in real estate, but to teach lessons to our kids and our grandkids. I can absolutely relate to you as well, John, especially with my kids and, one day maybe grandkids. But yeah, it just it can mean so much more than the dollars and cents. And that's usually what motivates us to get through the tough times. I would imagine you probably envisioned that moment where you could look your son in the eye and say, you know what, I'm a real estate investor. You still had that in your heart, in your head and in your heart as you were in 1991 coming from Jamaica, and you had that property that didn't go so well. And then as you ran into the challenges in Harrisburg, you never let that dream die. So really, really proud of you, buddy.
Thank you.
What rings out to me in that story is something that, like, every time I hear it, I feel like it bears repeating, but it's the idea that identity precedes behavior change. Right? Like that is something that you read about in Atomic Habits. It's something that I've lived myself, but like there's nothing like believing, like this is who you are, right? Like, John, you saw yourself as a real estate investor, or you, like, that was your mission. That was the identity that you had set for yourself that you needed to become. And at 63, you weren't going to give up on that thing, because that identity piece is one of the most powerful drivers of behavior, which is it's a big reason why I believe in this, like, community thing, right? Like, it's a big reason in like having a environment like the Not Your Average Investor community that people feel like they belong in, right? Because you start coming to the shows, you make friends with people, you realize that they're like you realize that at one point, wherever they are on their journey, they had the same kind of like desires and the same obstacles and whatnot, and it allows you to just kind of like keep that faith and keep going. And I think it's incredible that you were able to like stick to that at 63. And then the second thing is the why, right? Like I was just looking over Dr. Roberts' newsletter that we're about to put out, right? Like this idea of wanting to be an example for somebody else, like for younger generations, is something that continues to ring true across our community. Reggie Fonse has a very similar kind of why, like, right, and Dr. Roberts had it as well. So it just feels like two very powerful drivers is that idea of like identity, and that identity being of service to others is something that I find that's very, very common in taking these decisions.
It's common here, in this bubble, in this beautiful bubble that we have here in the Not Your Average Investor show. But guys, I've been around the block. I've been to literally hundreds, maybe thousands of real estate conferences over my 20 years in real estate. It is not common outside of our bubble. And I think real estate investors actually get a bad name, because when you ask them why are they doing this, you see ridiculous things like fancy cars and, all of this wealth that they're trying to accumulate. It's very hollow outside of our bubble. So I think it's a real credit to the people that we have, and the community that we have, and what we got to experience at Summit, especially, and with you, John. I mean, it is really special. So as a company, we're just so blessed. We just are so excited we get to work with this quality of people to be able to help you guys accomplish your goals.
So, John, you had your obstacles in investing remotely a couple of times, right? And then I know that you invested in education with Fortune Builders, and you set off. It sounded like your next goal was like, all right, I'm going to invest, but I'm going to do it here in my backyard of New York. Can you talk me through the obstacles there of being able to do that, and why you then decided to invest remotely?
New York is very expensive. The appreciation is good, but it's out of reach sometimes in terms of financing. And then if you finance it, especially if you're trying to do turnkey or semi-turnkey, you find that the financing is very, very expensive, and what you're putting up to acquire the property doesn't pan out in terms of even a break even most times. You're underwater because rents are not as high as they should be. Even if you buy the property, the rent is not going to cover everything. So you're going to be underwater. And it was very difficult to find the right property at the time for me that was going to be profitable even in the long run. Because I, as I said to you before, I was focusing on cash flow because that's what I had in my mind, what I was taught. Real estate is cash flow. Not realizing there were 5 profit centers that was going to benefit you in the long run. And thank God, when I came to the show, I found it out and it changed my mindset. Not to focus so much on the cash flow because that will eventually catch up if you go the full cycle, but focus on everything else in the Pac Man, as you would say, the appreciation, the principal pay down, the tax. These are and the inflation hedging. These are the things that I've learned and the education I've gotten just by being on the show and being around the community. And finding people who share the same objectives like you, same dreams, and then have a company that's not going after your money, but they want to make sure you succeed. And so, and Greg said it all the time. They don't sort of call you and say, okay, we're going to sell your property. You find out what your goals are, and then they tell it. And I tell you this, when I spoke to Sam initially, and she said, why are you interested in? And I told her why Central, and then she said, what are your goals? And I told her, and I said, my wife is a very important part of me making this decision. She said, tell you what, before we go any further, let's set up a meeting so I can meet your wife, talk to her, and we did that. She spoke to my wife. And my wife is very supportive. She might not be an active part, but behind the scenes, she supports me a lot. Every venture that I've ever participated in, she's behind the scenes supporting me, which is why I appreciate her very much. I love my wife so much because she's in my corner. And when she met Sam and Sam, she said, okay, John, do what you have to do. And then we went from there. So I just said, Greg, it's not just one call and we get your money. It's a series of calls before we get you going. So the process actually started in October. I made a decision in December. He spoke to us, reached out to us, did my goal sheet, my objectives, sent it to her, looked it over, get it back to me, questioned, and the process, the system that you have in place, very phenomenal. I must say, it works. And I like systems.
You like systems?
Systems.
Yep. It's a model. It's a model built by people who care. You know.
Man, I said this a handful of times at the summit, right? If there is one mistake that I made was to not spend as much effort bringing my wife along the journey of what I had learned, right? Like I think as the host of this show and as the friend of everybody in the community, like you said, John, it all becomes very real to me. And the desire to say, oh yeah, no, it's great. Just trust me. Like it's going to be awesome. I've seen this. Like I've met 50 people that have had a good experience. I know the owner of the company, right? And yet it's still my biggest opportunity is the way that I phrase it, right? Like my biggest opportunity, which is why I asked Martha to take time off on Friday.
It was so awesome to see her there.
Yeah, it was great. It was my biggest opportunity, right? Like this idea of having your partner understand why you're doing it, how it works, and just as importantly, who you're doing it with, so that they have like an equal level of not just like belief, but buy-in and trust is like it's the lubrication to the flywheel, right? Like
100%.
That's a really, really big thing. That's cool that you said that. It's cool that Sam recognized that, John. Because I'm the same way, right? Like I can't do it without my wife being on board because we're a team, right? And it's like now she's still on board, right? Like we're still growing our portfolio. But the biggest change has been that deliberate effort of having that communication with not just one stakeholder, but the other, like all the stakeholders at the table being on the same page has been a big difference for me. I'm glad you started that way. That's really wise.
I just think it's a whole lot more fun because what we're trying to accomplish is something really fun for each client. It's a goal, it's an outcome, it's something that matters a lot to you. And when we have everybody from day one moving in that direction, it's a whole lot more fun. Whoever the lead point of person is going to have a big burden lifted off of their shoulders because they don't have to explain everything along the way. We can do that together in the initial phone calls and really set up the relationship for success. So yeah, absolutely. That's something. And for those who haven't had an opportunity to speak with our team yet, we're going to say, if there is another significant other, we're going to invite that person to get on the phone. We want to meet them. But just like Pablo and John are talking about, it is critical for your enjoyment throughout the process.
Yeah. So John, what's the goal now? You're now an investor, right? Like you've crossed that identity threshold and you now you started at 63, right? So like, explain to me how you think of this idea that the five profit centers, how they will affect your life. Like what is the ultimate like goal of what you're building to these days now that you've like proven to your family that you can do this?
Well, the goal, as I said, is to set up, as I said to Sam, my goal when I initially started is to first I'm going to get one property, then I'm going to try and get 2 properties per year. All right, but I cannot jump the gun a little. Within less than a year, I got 3.
There you did.
Nice.
So, but the goal basically is to get about 10 properties. Okay, and then after 10 years is there, then I'll look at it again and reanalyze the goal, and the outcome is basically to have about 5, I'd say maybe 5 properties paid off in 10 to 15 years. Using the method that Gregg has said, Snowball in effect to pay down. And then, but I'm going to look at ways how I can pass this on to my kids. Least tax burden and at least way of causing a stress on them. So that's one of the things estate planning I'm going to be looking at. But the goal, as I said, is not so much because financially I don't really need the money to live on. But I want to build it so that their lives can be better off. And one person used to say to me, when they look at the fireman tail, they see my picture and say, "Granddaddy made a difference in this family."
Yeah,
that's beautiful right there. I'm curious. I can tell.
Can you explain the rapid paydown? I mean, he said something pretty. I think if I'm somebody that's new. By the way, I got a lot of feedback this weekend.
Yeah.
That like asking the question of like the dumbest guy in the room that I looked at was really helpful.
Yeah.
So feedback received.
Yeah.
Explain to me what he just said. Paying off a property. Paying off 5 properties in 10, 15 years. I think most people think that, well, like, man, does that mean that he got a 15-year mortgage? Like, what are we talking about here?
Yeah, great question. If we break down how are we going to take John to his ultimate financial outcome and help him accomplish that goal, there's really 3 phases to it. The first phase is the acquisitions phase. The second phase is strategic debt paydown. And the third phase is the most fun. That's your distribution phase. So that's where your funds are distributed. You've reached your passive income goal and you're able to live your lifestyle or fund whatever outcome it is. So there's three phases, and you have to accomplish phase 1 before you get to phase 2, and then phase 2 to phase 3. So phase 1 acquisitions, we have to have the right number of assets in the portfolio. We help you do that. We've worked with John, and it sounds like 10 is the right number of assets in the portfolio to get there. Then once we get that, then we can get to phase 2, which is strategic debt paydown. And so when John's talking about rapid debt paydown, that doesn't necessarily mean that John is paying money out of his pocket to pay those loans off. It doesn't mean that John's mortgages are 15-year mortgages. I would assume, John, are your mortgages 30-year mortgages?
Yes, they are. Yes.
30-year mortgages, right? And we don't necessarily have to take money and make additional payments. There's a lot that we can help you do to strategically pay your debt down so that you can cut the number of years until you have these properties free and clear simply by choosing the right loans to pay down in what order. And what happens is if you focus on choosing to pay the right loan down, put all of your cash flow towards paying down one loan, what will happen is that one loan will get like a supercharged effect of pay down. that loan will eventually be paid off relatively quickly. And then it starts to snowball. And so not only do you have the cash flow that you were putting towards that one loan, well, now that one loan is not there anymore. So now you have more cash flow, and then you roll it to the next loan. And then that gets paid down twice as quick. And now you have 2 properties that are free and clear. And then it gets even more fun, and it goes to the 3rd property. And the timeline to pay off the 3rd property is even less. So this is a part of the strategic debt paydown phase that we can help you do. We can help you do this. And then this is how you can really, really become efficient with your rental property portfolio and the dollars that you have, because we all have limited dollars. Well, if you know the right number of assets and you know how to pay the loans down, you can get to that timeline many times without even having to contribute additional capital to get those loans paid off, depending on what your timeline is. So we don't talk a lot about that, I would say. We get a lot of questions. Maybe we should talk more about the strategic debt paydown phase. But that's really I love things that can increase your return on investment or decrease the time to get you to your goal that don't require you guys to come out of pocket. And that's one thing that does.
Love that. Also a big part of Saran's story, which is a big inspiration for the talk track at the summit this week. So yeah, maybe we should. I don't think we've talked about C3X in a little while. Maybe we should do a show on that.
Yep.
Benny coming up with some really cool topics here on the chat. I gotta write those down, Benny. Okay, so John, you're planning to get to 10, and then you're going to reassess at that point. You don't really need the money to live today, so you're able to be strategic with it. And then this is a legacy play to teach your kids. You brought your wife along on the decision making. How much are you kind of like bringing your kids along on the decision making these days? Is that a part of the conversation, or your grandkids or anything like that?
Well, every once in a while, I'll sit on my kids and I'll discuss the JWB properties. But right now, they're in the building phase of their lives. So I'm not pressuring them too much with what I'm doing. I'm trying to lay the foundation, and then I'll let them build on the foundation. That's basically the step I'm doing. But they're aware of what I'm doing. I keep them abreast with what I'm doing as far as the rental properties are concerned. Yeah.
That's excellent. John, do you want to can we go over your kind of like purchasing journey, right? So John's portfolio he bought at the end of 2024. So it's a new portfolio, but I think there's some lessons to talk about on this one. You ready to see it? To see what Gregg put together?
Okay, great.
All right. So this is not a very long journey, but represented here, but this is it right here.
There you go.
Real quick, these are real numbers from John's real returns. This is not financial advice. This is not a promise of like future performance. This is just looking backwards, and we're not financial advisors. This is all do your own research.
There you go. Well said.
Nice. All right, talk us through this, GC.
So, John, first of all, John, have you logged in and seen your client ROI report with JWB, or is this new? Okay, so you do log in regularly?
Yes, I do. I'm
John, would you mind repeating it? It's a little hard to hear you.
I'm a spreadsheet person. I said not as good as you, but I put all my properties on a spreadsheet, and I track each one monthly, and I also track the portfolio monthly. So I'm like.
Respect from one Excel data nerd to another. That's fantastic. Well, great. Well, all right. Well, we're going to take everybody through your client ROI report. And for those who are not JWB clients, the client ROI report is one of the only things that I have seen in all 20 years in this industry that allows you to analyze your property returns from all 5 profit centers. And if you are a JWB client and you haven't logged in to see your own reporting, I would highly encourage you to do that. It always surprises me and causes a little tear in my eye when I have a client who tells me they haven't logged in. So John, thank you for logging in. What you'll first see is John's activity here. As we mentioned, he bought 3 JWB properties. He has his first one on Myrtle Avenue, his second one on 6th Street West, and his third one on Hartridge Street. And one was purchased at the end of 2024. And just like he mentioned, he came right back and bought the next 2. He was an overachiever even for himself and bought 3 properties in the first, about 8 months or so. Now we're going to learn a lot about how profits are generated in the short run here, because John is, really about a year into owning his first 3 properties here. And John has generated almost $18,000 in his first year. As you can see, his total profits are $17,666. But the way that John is getting there is very interesting. John is at a special moment in time here where there are a lot of cash flow credits that clients are earning when they buy properties. And so net rental income and cash flow is actually quite high. And then this past year, we had basically flat home price appreciation. So it's a cool time to look at, well, how do you win even if the market is flat in terms of home price appreciation? John, can you talk about those credits that you earned and how did that influence your decision to buy?
The first one that I bought, the maintenance credit, that basically helped to push me because I realized I was going to get back money when I spend money.
Yep.
So that was a good deal. And so I did it. And that was the credit, the reserve fund that helped me to do the repairs when I had the issue with the first with the second set of properties that I bought. Because I was able to fund the repairs without going into my own pocket. Because I listened to what Greg said, put aside some reserve money in case you have emergencies. And I'm glad I listened. The second set of properties, what spurred me was also the credits, but also you offer, I'm going to say, my terms are not very sharp still, but you offered a Buydown, like you get the DSCR loan with a certain percentage. And then at 5%, I said, wow, that's way below what the market has given. So I jumped on so I was able to get those two properties at a 5% interest plus maintenance credit as well. So those are the things that motivated me to get on board that properties.
You did great with that terminology. I tell you what, you are a real estate investor. You just mentioned DSCR loans and Buydown and credits, all really, really good things. I think on the surface, you're reading a lot of articles and people are saying, oh, this isn't a good time to buy and whatnot. But when you actually break it down, this actually is a great time to buy because a lot of builders are offering credits. They are offering Buydown of interest rates to ensure positive cash flow for rental property investors. So John took advantage of that. And I would imagine you had well over $10,000 in credits, I would imagine, from your 3 properties. And your interest rates have been somewhere around 5%, it sounds like. So a great opportunity to dig deeper. And we all kind of learn about this in the Not Your Average Investor community. But, outside of this, people don't know. So good on you there, John.
I was just talking to Leslie about it while we were on the downtown tour on Saturday. And it's the idea, I was talking about like bringing my wife along and all this stuff. And it's the idea that real estate has its own language.
Yeah.
Right? Like it's almost like you have to learn this new vernacular. And part of that is intimidating. And it's kind of like the entry barrier of being able to like relay that information to the people that you want to bring along. Part of it is just an entry barrier of like, man, these people are saying all these things that I don't understand. And it's really, really hard for me like see myself moving forward until you become fluent in the language, right? Just another thing I wanted to share that was something that came up a couple of times over the weekend of how people, like you said, John, like you become part of this community and you start to like understand the language and you start to do it. And even you right now, excusing yourself for not having the language like it sounded like, oh, you sounded like someone like learning a language, but you're fluent. Right?
Yeah.
Like you're already able to express it, man. It's cool.
We should probably, now that we've talked about how important it is to explain the language, I should probably explain what those terms are.
Yeah. That's a good call for the Noble Fool report right there.
So a cash flow credit is literally cash that you put in your pocket about a month after you close on your property. It comes through to you as cash received. It is not just money that is just sitting there and if it gets used, then it gets used or whatnot. No, just think about it literally as cash in your pocket. It is paid as a property management credit that is paid out on your first property management statement with JWB Property Management. And so those cash flow credits today are somewhere between maybe $7,000 to maybe $13,000 per property. So when you buy a property today with JWB, you walk in, you put your money down, maybe $60,000 to maybe $75,000. And then let's just say on average, it's about a $10,000 cash flow credit. Well, that comes right back to you within your first month of ownership. And the key here is what we advise is just what John was talking about, is that this money now becomes your maintenance reserve, because I want you to have a wonderful experience and I want you to buy and hold for a full market cycle. And the best way to ensure that is making sure you have reserves, as well as, of course, us preparing you for the good times and the challenging times. So clients are taking that, let's just say, average of maybe $10,000 per property, setting it aside in a bank account, and now you're ready for the moments when something that you don't want to happen happens, like a property turn or something, and you're prepared. So that's really, I think, the best part of this environment that we're in right now. Cash flow credits are available, and I think it's ensuring positive experiences for clients for, hopefully the next decade or two. So that's really exciting. So that's cash flow credits. We talked about rate buydown.
Real quick on the cash flow credit piece. I had another aha moment around that, right? Because during the summit, John, we all had times to sit down with our portfolio managers, right? So everybody kind of like took that time. It was one of the reasons I wanted Martha to come on Friday. We sat down, Fritz.
Yeah.
And, he went over all of it and then explained the cash flow credit. And in the explanation, something hit me. When I see my rental income hit my bank account every single month, it's not like happening. Like I don't see, right? Like right now I'm positive $350 something in revenue. I don't see $300 hitting my bank account. Right. Like I see like $4,500 hitting my bank account. Right. Like I just see like the rental income hitting my bank account.
Yep.
And so even if with these cash flow credits that we're getting, you're still going to see the rental income hitting your bank account. Like let's say that these cash flow credits are there to kind of like make up for extra cash flow, right? Like you basically spread it out over 3 years to make up for what the like year 3 cash flow is. Psychologically speaking, you're still paying your mortgage out of like, one side of the brain, and then you get the revenue on the other side of the brain, right? So like there's still that like positive pleasure center in the brain. And as long as you have that $10,000 buffer there, even if you're using it out of the same bank account, it still serves as this like really nice insulating layer over what you see. John, do you have all your cash flows coming in and out of the same bank account, or do you have it like separate? How does it work for you?
I separated it. I have a separate bank account for my real estate investment, and I have my personal, so I don't mix them. Everything is paid. All the mortgages and the taxes are paid from the rental property account. I don't mix my personal account with that account. I keep them separate. Good advice from Gregg.
Thank you, John. I think setting aside reserves and having your bank accounts separated from your personal funds are so critical to ensure a positive client experience. Because the alternative is, if you have money in your personal bank account and it's coming in and it's going out and all this other stuff, I can guarantee you the first time that you have a maintenance item that's unexpected, or the first time that you have a property turn, you're not going to remember all of the positive cash flow that hit that bank account before. You're just going to think about spending $3,000 on something you didn't want to spend. So it is such an important and simple step to set aside your bank account, separate them, have your personal funds, and then have your rental properties bank account. Inside your rental properties bank account, make sure you set aside reserves. What I would recommend is a kind of a time-tested way to go about reserves in really any business is to have maybe 3 to 6 months of expenses set aside for each business. Well, let's apply the same thing for rental properties. It comes out to about $5,000 per rental property. Build that account up to $15,000 of reserves for your 3 properties. And when you're there, you should be good, because by the time you have 3 properties, you have a significant amount of cash flow that's coming in every single month, and you should be good for reserves. So little known, we don't always discuss it, but a very critical part of client success.
Yeah. So you're going to talk about rate buydown?
Yes, rate buydown. So when you go and you get a loan, either you as the buyer of the loan or the buyer of the property or the seller of the property have the opportunity to get a better interest rate for you. And what can happen is either the buyer or the seller, JWB, can actually buy down your interest rate, which means that we pay the lender some more money so that the lender gives you a decrease in the interest rate. And at various points in time, the credits have changed and the buydown has changed. It's very dependent on what overall mortgage interest rates are for the market at that moment. John was able to have an experience where we bought down the rate to 5%. And as we're sitting here today, JWB is buying down the rates for our clients as well. And that's why clients today who are buying are getting sub 5% mortgages. It would be higher than 5%. And then JWB steps in and we actually pay money to the lender on your behalf. And so now that interest rate for you is sub 5%. So that's what a rate buy down is. And then the last term I think was DSCR. It stands for Debt Service Coverage Ratio. Fancy terminology.
That just explains itself.
Yeah, right. It's fancy terminology. It's just a type of loan that is really popular right now because what it does is it's a type of loan that is basically substantiated by the positive cash flow that comes in your rental property. Debt service coverage ratio simply means that the lender looks at what's the ratio of the debt service to the rental income. And so because you're investing in properties that are positively cash flowing, they are going to be much more, the DSCR loans are easier on you to qualify for, and they're really attractive in the space right now. So DSCR is one type of loan. There are regular conventional loans that are also very attractive as well. So when you sit down with our team, we can talk through the pros and cons of each of those and really help you settle into the right loan for yourself there.
And you put all that stuff together, and this has been John's experience. Now, we're used to seeing this thing look like a Pac Man, but it's normally the home price appreciation that makes up that Pac Man. Today, it's the cash flow. And you want to explain that, GC?
Absolutely. This is the old reverse Pac Man right here.
It's a wrestling move.
I love it that John truly understands the way to build wealth is to focus on all 5 profit centers and to not focus too much on net rental income. And as we put your profit pie together here over your first year, yours is actually very heavy on net rental income. You know, what we teach obviously is a much longer time span than your first year. And if we think about what's happened with John's experience over the last year, it's been an environment where home price appreciation has basically been flat, which is unique. We usually have more points of home price appreciation. And John came in and got a lot of cash flow credits right off the bat. On your client ROI report, that shows up as net rental income because that's what that is. So it's a unique moment in time. Over time, the Pac Man principle will come to fruition for John, just like it has for you and everybody else. And the way that we really look at portfolios where we start to actually generate what your rate of return is usually after about a 3-year time frame. That's where things usually start to settle down, and that's where I would imagine your Pac Man principle will come to fruition, just like everybody else, John. But hey, nothing wrong with having a significant amount of cash flow in your first year, what I would imagine, right?
Well, put it this way. At least it fulfilled a part of my dream when I was focusing on cash flow. Now I
There you go. Nobody complains about having too much cash flow, I can tell you that.
Yeah, for sure. John, I really appreciate you coming on and sharing your story, man. This has been great. Do you have any kind of like parting lesson or anything kind of like top of mind that you wanted to share that we haven't gotten to here?
One of the person who kind of helped motivated me to was an episode you did with Lee, MVP Lee. When he
we've heard of him.
A big fan of mine. When he talked about how he used his retirement accounts to purchase his property. And for my friend property, basically what I did was I went into my retirement account and pulled the money from there to buy my first property. That's what I did, because I'm saying a stock market is volatile. And if it goes to zero, you have lost. And single family home, hard asset, when you buy it, it doesn't go to zero. Even if it doesn't appreciate as fast or lose value, you still have the asset, the value of the asset. And that's what kind of helped me make this decision to pull out my retirement money and invest it in single family home because you will never lose. And if you give the market cycle the time, just like the stock market, it will build back. But you still have this asset that's generating income that you're not going to lose. And that's what I love. And that's what kind of help me to kind of make the first move in that area. I was think I would just I'm gonna repeat what you've all said on the show. You need a team that has your interest at heart. And when you get the team in place, then you look for the asset. That I cannot emphasize that enough. If you're thinking about going on this journey, get a team. JWB is a solid team. And I can say from my experience and from what I've heard from the community, they have your interest at heart. And if you work with them, they will make sure you succeed. They say there's no guarantee, but I almost give this a 99% guarantee that JWP will make you work. All right,
John,
so,
thank you so much. Thank you for saying that. To know that we had an impact on you to help you accomplish your goals right now to become a real estate investor means a lot. And to hear you, isn't it cool when we hear clients that are speaking the truths that we have spoken? You know, like
it's wild. Like the amount of like repetition that we've heard of like the team first approach, particularly in the last couple of months, it's like there's like an uptick in it. And I'm like every time someone repeats it, John, it just totally fills my bucket, right? Because it's like we stand up here, we do this show every single week, right? Like we're always like challenging each other to talk about new things and different things. But you start to realize that, you know, when you're really trying to like make an impact, when you're really trying to help people learn something and actually, you know, not just at a topical level, but at an application level that they will actually take action on, it's really like repetition is at the heart of it, right? Like, and the more that we repeat it, the more people start to understand it. And the more that we, you know, take it from over here and bring it right into that language of like team first, it's just like, it's very rewarding from like the content creator kind of like standpoint to like hear this. So it really, really fills my bucket, John. Thank you.
You're welcome.
Yeah. And we want to thank the rest of the community that's been here. You know, like first of all, this feels like a summit, like a summit reunion. A lot of folks that were at summit are here. Just, I think I heard from everybody, best summit ever, right? Like, I heard it over and over and over and over. John, I hope that you can join us at the next one, man. Like that, the feeling in that room.
I'm going to try. I'm going to try real hard.
Yeah, I hope so too, man. That the feeling in the room really is something special. And the reason it's special, it's because of the folks that come to this webinar every single week and like take time to like get to know each other, take time to like learn the common language, and then take time to come on and share their story as well, John. So really thank you. And thank you to the community for doing this. Do you see?
Yeah, I thought before the show, how could we possibly share how impactful Summit was for those who were not at Summit? And I just don't think it's possible. I just don't think it's possible. It was such an incredible experience. I want to thank everybody who came to Summit. You all made Summit what it was. There was a lot that we tried to bring to it to make it special. And I know that was all received very well, but it's you guys. It's all of us being in the same room together and, you know, eating lunch together and having dinner and having a few beers and all of this good stuff. I mean, it was awesome, guys. So thank you for making it what an incredible success. And we just can't wait till next year for Summit. It's going to be great.
So until then, we'll see you on the show next week. John, what's the parting piece of advice that we have for everybody?
Don't be average.
Don't be average.